Thank you. Everyone can hear me okay? Good, excellent. So we've got a panel of 5 and one with a broken ankle. So Glenn will, got to let Glenn sit here, not walk the furthest, surely, come on. Lots to unpack in half an hour. So we're going to get straight to it. You can Google these people and find out their backgrounds and their intros and LinkedIn them, connect them, and etc. We're going to go straight to Paul, because your business was up front just before pitching PE. What's happening in the PE world, Paul?
So there's a lot happening in the PE, always has been. I'll start off just quickly, talk about the differentiation, and thanks everyone for attending this event, and thanks Steve for hosting. We've got VC and PE people up here. I'm from PE side. You heard one of my partners up here talking about Grabber. VCs, early stage, smaller check size, shorter term investment. PE, larger check size, longer term, and are investing in more complex businesses. As Richard explained, we invest in companies that are already trading, already profitable, and already looking for global expansion. So that's the first stages. Rather than VC, which is around ideation through activation and implementation, our work is around commercialization, scaling, and realization. So it's the next phase down. So the other things we look at is we look at strong thematic investment styles, Chris, and making sure that we're focused in very carefully on exactly what we do and what we don't do. So we kick out a lot of investments. We've looked around 800 already. We kick a lot out on the basis that it's outside of our investment thematic. And we are focused, as Richard said, on companies that make things, companies that are growing, and companies that are building complex products that have a really good IP moat.
And Paul, the team that you have when putting a check in to a company, what else can you offer besides money and what you call smart capital?
So what we're offering, because each of us involved in the company have commercial experience. So I've been in the US for nearly 20 years. I've been in Europe for more than 20 years. I still have companies in both those markets, profitably trading and growing. I have my electronics production facility in Sri Lanka in a factory I own over there, and I have 88 staff there at the moment and growing rapidly. And I've been in Australia for 32 years in manufacturing. Andrew Liveris, former global head of Dow Chemical, one phone call away from any serious CEO anywhere in the world. And he's proven that with some of the contacts he's already made for our investables. So the smart capital side of it is not just around the technical side, but it's the business acumen of being able to go into a market, form a company, get it right first time rather than backtracking and restarting that process.
Jesse, we'll go to you now in regards to your area of expertise, which is sort of pre-seed, early emerging tech. Can you talk about the trends that you're seeing there, and why should a company come to you as opposed to maybe a bigger behemoth?
Yeah, for sure. So for context, Afterwork Ventures is a $20 million fund, and we make investments in pre-seed to seed stage tech companies. It is in the ideation phase or the finding MVP, developing an MVP, finding product market fit stage. And our check sizes, the average check size is $250K, scaling up for $1 million when we double down in our high conviction bets. I think when startups are thinking about which funds to choose as their investors, looking at fund size as a proxy for fund strategy may be illuminating. So it's a lot easier to turn a $20 million fund into a 4 times fund into a $100 million outcome for our investors than it is to turn a $1 billion fund into a $5 billion fund. The delta in absolute value creation that you need to drive in an Australian tech startup just can't be denied, which means that when we make investments, we don't necessarily have to target companies that are shooting for the moon and wanting to become a unicorn or a decacorn. We can have a very good outcome for our fund if that company reaches, 20 million of EV and has a range of exits, including a listing or an acquisition. So that's something that I think startups should take into account.
And Jesse, the trends over the last couple of years, 2 years ago or 3 years ago, we might have been talking about cryptocurrency or blockchain technology. Now everyone's talking about AI. Can you talk about some of the trends that you're seeing of the companies that you see and potentially invest in?
Yeah, for sure. What I've been thinking about a lot is, in VC in Australia, a lot of people say B2B SaaS is the best business model in the world. There's this business model that spits off 80% gross margins, it's recurring revenue, you can expand to the same customers, and it's a money generating machine, right? And I think that when you think about the fact that Coles is being dragged over the coals, over the coals, for generating a 3.3% net profit margin, I think you look at something like those SaaS margins and you realize in some ways it's quite an immature a business model that only cropped up in the last 15 years or so, and that the ability to have those 80% margins perhaps speaks to a lack of competition and a scarcity or cornered resources, like the ability of engineers to create software. And I think AI is potentially disrupting that strong, that ability to protect those gross margins, because the cost of developing software, the ability of engineers to leverage AI co-pilots to create really sophisticated, feature-rich products is accelerating. So I think it's a question of, will SaaS companies be able to maintain their stronghold, and might we see different form factors of successful companies? Something we've been looking into is, for example, AI agents, which instead of SaaS, which puts a workflow on like guardrails, an AI agent is able to be a lot more flexible in executing against a command, and could be the next form factor of the next set of great companies.
And James, we've gone from sort of small venture capital and what Jesse's seeing to big behemoth companies that make, I don't know what NAB's profit was, of something maybe $6 billion a year. Now the venture arm of NAB, all the big four banks have got venture arms. Why should someone come to you, and what trends are you seeing in CVC? Just corporate venture capital, by the way.
Sure. Thanks, Chris. I mean, look, I think it's widely known there's been a bit of a correction in the VC and startup ecosystem. And I think in that climate, we see that the value proposition that a strategic corporate VC fund like us can offer is more compelling with founders when they're looking for potential investors. And that's because basically NAB Ventures invests in startups that we look to partner with NAB, where we can drive revenue directly to the customer and also enhance the tech capabilities of NAB. And usually we'll do that in one of two ways, either where NAB is a direct paying customer of the startup, which is usually for sort of core foundational capabilities, so things like AI or cyber. Or secondly, if it's something more closely related to like fintech or banking, where we will become a distribution partner and we will sell the startup and its products onto our existing customer base, whether that's individuals or small businesses or up to corporates. And that's often a very efficient way for a startup to reach scale and to get sort of defensible distribution channels and a path to market. And in a climate now where there's growing pressure on achieving revenues, there's compression of valuation multiples, there's a need to show a path to profitability and unit economics, it's much more attractive to find these sorts of distribution partners than to sort of launch a direct sales to motion, a direct sales function to a large realm of existing customers. So that's why I think we find that resonates more. But I think also in a downturn, it's important that you have patient capital, which we are, because we don't have to return a fund to investors. We don't have a closed funds. We don't have to exit after a certain time frame. We don't have to sort of report on metrics in order to raise our next fund. So we can have a sort of long-term focus on value creation. And also I think we can be a high conviction investor because we know that we're going to create some of the value for this startup, and we can have a high degree of confidence in the size and timing of that opportunity.
James, when it comes to the board level strategy around what particular verticals they're looking at, has that changed over the last couple of years? Obviously, fintech was pretty hot a couple of years ago. Now, with the bank, they might have deviated in and around, maybe cost of living or property, etc. Can you talk about the different verticals that you're looking at as a CVC?
Sure. Yeah. No, I mean, I think in financial services at large, the realm of relevant sectors has expanded. So we have a lot of, investments in sort of AI and cybersecurity as well. And one sector that we're looking at a lot more now is climate tech. And, I did a work trip to Europe last year, and there's lots of major global banks launching multi-$100-million funds dedicated on climate tech. And I think that's because climate change poses a significant threat and an opportunity to banks. So from a threat, the major asset class that we are exposed to is property. It secures almost all the loans of banking, and whether that's residential mortgages up to like farms and commercial property. And we need startups that can better enhance our capabilities to measure climate risk and incorporate that into credit risk. And that's whether that's the risk of natural disasters that destroy a property, or even just a farm yielding less revenue than it used to, or when you see something like a flood in Lismore that affects every small business in that town. It's just trying to understand how the interconnected effects of climate change impact risks in financial services industry at large. But I think it's also a major opportunity because it's going to cost a fortune for the world to transition to net zero. And I think there's a big opportunity, an important role for banks to help finance that transition and help assist our customers along that journey. And so whether that's from, homeowners finding, measuring the carbon footprint of their home and, being linked to a green loan to fund a solar panel for their roof, or whether that's small businesses that now have increasing regulatory reporting requirements and need a good way to calculate their carbon footprint, or even up to the big end where you see corporates that need like a way to fund liquidity and to basically participate in voluntary carbon markets to smooth out that transition. So I think it's not just NAB, it's all sorts of banks now finding ways that they can help finance and facilitate that transition.
Glenn, I'm going to skip you, not because you have a broken ankle, but we'll come back to you. We're going to go straight to Singapore. Dr. Joseph, firstly, you're the only doctor on the panel. What's the doctor? Tell us about that.
Poor health decision, permanent head damage, phony doctor. So I'm a scientist. I worked on new cancer development, new cancer drug development, nanoparticles and all that sort of stuff back in the day.
And you've come from Singapore and you're floating around. You've got the health tech fund. Can you talk about that health tech fund, what you're seeing, and whether you agree or disagree with some of the trends that you're seeing here in Australia?
Well, all right. So I think it depends. It depends on the asset class. It depends on what industry you're focusing on. It depends on the stage. It depends on all these different variables. Now, I'm a bit of an odd man out here. We invest globally. We invest at the earliest stages, so we can be the first capital. We've even spun something out. Don't recommend it. And we can go as late as Series A if it's strategic and accelerates the development of some other portfolio companies. And the reason we do this is we do want to have a great impact on health systems around the world. We want to invest in technology that can move the needle for millions of people around the world. And in order to do that and make a market level return, you have to go early. Because in our sector, the exit story hasn't been a very good one yet. Although I have staked my career on believing that we're only going to need more technology as time goes on in healthcare as we get older and sicker, as all our nurses are getting burned out, as our doctors just don't have enough of them, as we don't have physical infrastructure in growing markets, and then in decaying markets, as like to say, or declining markets, it's all an efficiency play. So, what are you going to do? Is there going to be less technology or is there going to be more technology? And I think clearly more technology. Although we've had a clear, spectacular failure in health tech. You see what I did there? The very punny, right? SPACs, spectacular. Anyways, so pretty much every
We do a trivia game like Name a SPAC. I don't think I can name any of them anymore.
23andMe, Prenetics.
All right, you can. Well done.
Babylon Health, Teladoc. So they've all like pretty much screwed the pooch. And I think that was a function more of the financial instrument than the actual business. You foie gras these startups with more money than they could possibly deal with, and then you tell them how to spend it, and it's like, all right, yeah, that's. And then promoter, pockets a good amount. All right, good job. We've seen this before. RTOs, reverse takeovers, shell companies, all that sort of stuff. So anyway, in terms of like trends, venture sucks right now. It totally sucks. Like it's hard to raise money. Startups are dropping left center. In your space, OpenAI is killing 100 startups a week. That means it's a great time to invest. There's never going to be a better time to invest than probably last year. Yeah. And it is seasonal because, when, they say when the US sneezes, the rest of the world catches a cold. US was deep frozen for 2022, 2023, it's starting to warm up. Europe is starting to, looks like there's sign of spring coming. Asia still deep frozen. People don't seem to be starting companies anymore. But paradoxically, valuations have not fallen because losing face is worse than losing money, it seems. So again, my context and data point, I'm very narrow. I only look at healthcare technology. I only look at early stage. I only look at things that are rather esoteric. So please take that in context with my observations.
Just on that point around health tech and AI, you mentioned about OpenAI there. Are you scared of AI?
Short term, no. Long term, yes. Ultra long term, no. And I think it ultimately comes down to the question of, are we pets or vermin? Right?
Show of hands, you think, or not? No?
Yeah, show of hands. Pets. Are we pets to these super intelligent machines? Fuck. We're sorry. Sorry. That's really indicative of where people are feeling here. So we see AI as an existential threat here by the process of elimination, with a single person saying we'll be pets, not vermin. That's scary. But in the short term, super useful.
But the long term, you said you weren't scared.
Well, yeah, because we won't be around.
All right. Okay. There you go. Well, that sums it up. Anyway, on happier topics, we're going to go to Western Australia, Glenn, about what's happening in the West in Fund WA. What are you seeing? And also like the emergence of regional areas, and I'm from Brisbane, so we can sort of, Western Australia, Queensland sort of regional areas, that basketed in, and sort of angel groups and the emergence of, predominantly not Eastern Coast cities being a hub for money.
I want to tie two concepts together. So, hello, testing. Yeah, okay. So I want to tie two concepts together. So something that Jesse said around fund size being destiny, and that smaller funds actually have more capacity to return higher multiples for investors. And as an investor, myself, that's all I care about. I don't care how much money someone else made, I care how much money I made. So I care about the multi I made of my money. And the second concept I want to tie into it is actually that talent is evenly distributed, but opportunity is not. So combining those two, if you're a large fund, you can't be in a regional location, right? It's too small for you. Right? So if you've got $500 million to deploy, you can't be in a small city, right? It's just not enough opportunity there for you to warrant your time there. But that's actually where the opportunities are getting coming out of. Right? There are just as many smart people in Perth or Brisbane as there are in Sydney, proportionally to population. And those people are inventing things, they're creating startups, but they're overlooked. And so if you're a large fund, you don't care because you can't afford to look at them. But if you're a small fund, you can. And you can actually look at those companies and look at those opportunities, and you actually have kind of unconstrained deal flow because you're not fighting with 150 other funds, for good deals. You actually see better deals kind of in these environments. And so from a startup founder point of view, it really sucks. Because there's only a couple of games in town, one or two perhaps funders that you can talk to. From a funder point of view, it's fantastic because as one of the one or two games in town, they have to come to me, and so I see everything, and so therefore I can basically absolutely cherry pick the kind of best kind of deals. So it's interesting. There's kind of this from a funder point of view, it's great, but from a startup point of view, it's bad. But we mostly hear the startup point of view around this about how terrible it is in these environments. But I think basically the rise of like smaller, more focused funds in some of these more regional areas who are professionally managed and run and are actually able to look at kind of really good returns they can get by operating in a kind of narrow niche, I think is going to change things. If you look at like perhaps Perth or WA or Queensland as kind of regional areas, on a global perspective, Australia is a regional area. Like we are distant from the main kind of capital markets in PE or VC. So the kind of stuff that we might do across Australia, we should think about replicating back down into smaller environments here in Australia as well.
Paul, I'm going to go back to you in regards to emerging technology trends, what you're looking for when you invest in PE. Obviously, you said there's some mandates around manufacturing potentially and profitability, et cetera. But then what's underpinning that is there's some great tech, great people, et cetera. And then from that, when you invest, what sort of time frame are you giving them to succeed?
So, so we mentioned before about what we don't do, fintech, medtech, SaaS, don't do that. But with medtech, we might do medtech. So if they make something that could hurt if it dropped on your foot, we would look at it because they're manufacturing something. Whereas fintech, medtech, fintech, SaaS, probably outside our range. But we like companies that make complex things. So in Australia, we've got 47,000 manufacturers. 90% of those employ fewer than 20 people. So that's a cottage industry. Then you've got that top 4,000. Of that 4,000, a large number of those don't need private equity money. They're the Anchors of the world, Incat, those sort of Elphinstones, those types of companies that already have a global presence. Then you've got that slice in the middle that are able to sustain a growth and sustain a check size of 5 to 15 million or $20 million. Because, as I said before, you can't just throw money and say, right, go and burn that. So we look for companies that have that ability to have a product that has global reach and a global appeal, defendable, and has deep tech that is safe from cyber attack and that sort of thing. And that's where the Grabber one fits in beautifully. But we also look for companies that are willing to collaborate. You can't have 47,000 businesses in Australia, cottage industries, that want to scale, you can't scale that. You actually have to get companies together. So we're looking for strategic bolt-ons and add-ons into those companies as we grow them. And we're seeing where there's some crossover technologies between drone technology, for example. Grabber does drone, does identification via drone, those types of things, even biometric identification via drone. So that is a crossover into some of that other area that has a defence play as well. So if it's got defence in it, if it's got high value add and very high margins, that's the thing that appeals to us.
Jesse, we can't talk about investment trends without talking about valuations. About, 2 years ago, a PowerPoint idea would sort of get $10 million valuation. That's changed. What are you seeing now in 2024?
Yeah, I think there's more of a focus on capital efficiency. So I think, in 2021, there were these really big seed and Series A rounds raised in Australia, $10 million seeds, $30 million Series A's. And I think, you'd think that 3 years on, that there is this cohort of early stage companies that were extremely well capitalized that are coming out of the gates absolutely roaring into a really big Series B led by a top tier US investor. And I think that the fact that you haven't necessarily seen that wash through has made a lot of VCs question whether capitalizing a seed stage startup that hasn't found product market fit yet with $10 million is doing them any good. I think someone on the panel used the term foie gras before, which is, stuffing money down the goose's throat until their livers are fatty with, ping pong tables and kombucha on tap. And actually,
We got lunch served soon, right?
Creating a situation where companies, overhire, create all of this communications overhead in their organizations and can't pivot as quickly to get to the red hot center of where there's product market fit. So I think valuations are coming down, not necessarily because VCs see an opportunity to get incredibly pointy elbowed and shortchange founders, because valuation is always triangulating against, how much money do you actually need to raise to digest efficiently to get to the next set of funding milestones.
What about you, James? Is the bank taking a few bets on a bit blind, saying, "Oh, actually, this is something we've been looking for a long time. I know there's no revenue, but it fits into the bank mandate. Let's chuck $5 million at them."
Well, no, I mean, we invest in companies that are at a scale where they can partner. So we're a bit later stage. The worst thing you can do really is, a seed stage company try and partner with a global corporate, and you'll burn cash before you see revenue. So I think we are a bit later stage. I mean, I think what we found is that there used to be certain metrics around, say, if you were doing a Series B in the USA, you had to be at sort of 10 million revenue, and if you're doing sort of a Series A, you had to be sort of 3 million revenue. And we found that during the peak period, those revenue thresholds fell significantly, so that companies were doing large Series Bs before they'd hit the usual commercial milestones that would normally be associated with that. And now it's raising back up to where it was pre the boom. And so what that means is a lot of companies that have sort of done a Series A or something, but they haven't reached the metrics to do a big Series B round. So there's a lot of small bridge rounds. There's Series A, 2, 3, 4, pre-Series B, blah, blah, blah. And a lot of it is just because companies haven't got into the sort of growth equity sort of mandate yet, but they're sort of still in kind of like this twilight zone. And it has a few impacts. One is that there's a lot of companies doing small raises that only buy them sort of 9-10 months runway, and so they have to raise a lot. But it also, I mean, it creates opportunities if you want to double down and you're a conviction investor that believes that you can create value for them. So I think it's just a sort of natural sort of shakeout process that we're seeing in the sort of mid to later stage of the market as they try and they fall between the kind of two pillars, but it gradually will grow into the sort of sector that they were on the cusp of before, which is the sort of growth equity kind of sector.
Glenn, I'm interested in your views about being a domestic-focused company versus having global ambitions from day one. It's a topic people talk about a lot, and the deployment of money. Let's say, hypothetically, I'll give you $50 million now. Could you deploy it into opportunities that you're seeing straight away, or is it you think that it's a little bit softer from the deal flow point of view?
Interesting you mentioned about being a domestic company without, kind of global ambitions. Because that's the tagline on the front page of our website. Is that we look for companies.
Look, I do my research as the MC, right? Talk to you.
Yeah, that's the companies we look for, right? They might be in a regional area, but they've got kind of global ambitions kind of from day one, and they want to be a global company from day one, and that's kind of what they're seeking to become. I actually want to riff on something that Jesse said. Actually, so someone last week described me as Warren Buffett. as a value investor, which I thought was quite strange because I'm a venture capitalist. And so I'm a speculative.
You're not 96, right?
I'm also not 96, right? So I'm not as rich as him either. But like I'm a venture capitalist. I'm fundamentally a speculative investor. I'm investing at seed stage, potentially before the company has any revenue at all. So how can I be Warren Buffett and still be a speculative investor? And it comes down to I'm trying to invest in the companies that will be value companies later. So they're ultimately going to become a value company, and I try to pick those at kind of an early stage. And I think what was happening in kind of a trend there was that they were, as you said, Jesse, faux growing these startups and stuffing them full of cash in the hope they will become a valuable company. And I think basically ignoring what a value investor would look for and how they would actually operate. So I think you can actually think kind of both speculatively and also as a value investor in kind of both ways.
And Berkshire Hathaway's never paid a dividend, by the way. So Warren Buffett's company, Berkshire
Do you mind
Hathaway.
if I riff on?
Yep, go for it. Yep.
Yeah, I was like thinking back to, the way we've evolved and how we make decisions. Something that I felt us becoming more and more gun shy about because we have, tender fingers is taking risk. Like, for example, business model risk, where you're not actually sure how this startup is going to make money. And I think that we'd be poorer if all VCs decided that they, really wanted to shy away from any business model risk, because I think when you look to, great startups today like Facebook and like Twitch, they had completely different business models when they started to what they do now, but there was that kind of focus on a product insight, and then that evolved into a monetization strategy. So I think, even though I think everyone's kind of learned from this ZERP mania not to invest unless it's kind of clear how a startup makes money, I do think it's incumbent on us as venture investors kind of trying to propel innovation to still have the belief to take certain kinds of risks.
Now, Dr. Joseph, we've got 3 minutes 50 left till lunch. You've come all the way from Singapore, so I'm going to give you the last 3 minutes 50. Okay, you ready?
Oh, it's very kind of you.
Yes, so we've got question. We've got $50 million in health tech. Could you deploy it in the next 12 months?
Yeah, totally.
There's
It's very easy to deploy it. It's very
good
difficult.
quality companies.
Yeah, totally.
Yep.
Yeah, I've got 190 countries to choose from. And, we see 2,000 companies a year from 45 countries. That was the last analysis point I did. There's a point to deploy it. It's just the question, would you want to deploy it in 12 months? Would you actually want to kind of ration it, get some inter-vintage variability? Would you want to, be strict to your thesis or not? I mean, there's many ways to deploy money, right? Sorry, it's a bit of a non-answer. I mean, there are great opportunities around the world, but there might be even better opportunities next year. There might be even better opportunities than that the year after. So the question is, do you stick to your guns, stick to your stage, stick to your thesis, or do you vary when you have more money than you know what to do with? And right now, yeah, I could, but I don't think I want to.
Yep. And you mentioned SPAC in terms of exits and liquidity events for investors. What are you seeing in healthcare? I mean, is the IPO market stalled, broadly speaking?
Yeah, it is and it isn't, because also the M&A market in the US is stalled because of Lena Khan, unfortunately, FTC chair. Sorry, for those who may not know. I think trade sales are still the most viable exit opportunity for health tech startups. So it behooves you to figure out who might be your future acquirer and get to know them on a first name basis, at least 5 of them before you write a check into a company in the early stage. Secondaries are also a real possibility because, there are folks that want to de-risk an investment by having someone else, hold on to it for a few years. And if a company's doing well, you'll make money on it. If the company's not doing well, you at least get to exit your position and get something back. But IPOs, unless you're a complicated business or you're trying to do something that's not strategically aligned to, an existing incumbent, then that's also a viable option. But then the question is, are you doing an IPO with a capital I or a little I? Because there's lots of markets where you can do an IPO with a little I, and those are kind of neither here nor there, because you now have the downside of being a small company with the regulatory overhead and the transparency of quarter-to-quarter reporting when you have 10 years until you're going to show something.
Are you, like in Australia, we've seen the likes of Canva held by 3 major VCs all the way up to a point of where it is now in the sort of 40 billion mark or whatever it's marked at the moment. Are you an investor that wants a moonshot like that, or are you looking for the ones that maybe like 3 to 5 times and go, actually, I can see a exit in a couple of years, and that's actually really good?
So unfortunately, the venture math is against you if you're trying to aim for a 3 to 5 in every company. We're not PE. So 3 to 5 is a reasonable outcome if you're going to try to get a 100% hit rate on that 3 to 5x. So anything we go into, there has to be a risk-adjusted 20x from here, because you're going to have a power law distribution whether you like it or not. So for me, I don't like having companies die because that problem remains unsolved. It's not because I'm accepting, oh, it's going to be power law math. No, that founder failed. That founder dedicated 10 years of his or her life to solving this problem, and the problem has remained unsolved, and the founder's likely broken and ruined as a consequence of that. So I don't like seeing companies fail, even though that's the eventuality. But anything we go into, there's got to be a 20x from here. And, and there's also questions to be asked. And sorry, this is probably like oh shit, 4 seconds. Venture capital is an access class, not an asset class.
And on that note, we're going to have some lunch, but I'd like everyone to thank the panelists today. Thank you.